Welcome to the Nifty Noon podcast. I'm your host, and I have to say, looking at the research from this past week, it feels like we just lived through, I don't know, a year's worth of financial history in about 5
It
days.
really does.
It is Sunday, January 18th, 2026, and yeah, the landscape has definitely shifted under our feet.
It's great to be here. And you're right. We're looking at a week where the lines between traditional finance and crypto didn't just blur, they practically dissolved.
We have the biggest custodian bank in the world putting deposits on the blockchain. We have a former mayor involved in a rug pull,
Unbelievable.
which is a sentence I never thought I'd say. We have the Senate trying to, rewrite the laws of physics on yield. And of course, Bitcoin is knocking on the door of 6 figures.
It's a collision of worlds. I mean, you have the suits moving in with this heavy, serious infrastructure at the exact same moment let's say the degens and the bad actors are getting flushed out. It's a very specific kind of chaos.
Right. So before we get into the day-by-day from our newsletter, can you give us the TLDR? If you are completely offline this week, what are the big movers?
Okay, the executive summary. First, BNY Mellon, the world's largest custodian, officially launched tokenized deposits. This is a massive plumbing upgrade for the global financial system.
Okay.
Second, corporate conviction is unshakable. Michael Saylor's strategy company bought another $1.25 billion in Bitcoin.
Of course they did.
Third, a new Senate draft bill that kills passive stablecoin yield, which is huge, but it kind of protects DeFi. Fourth, the market loved all this. Bitcoin hit an 8-week high, flirting with $97,000.
Wow.
And finally, a big cultural shift. Elon Musk declared war on InfoFi on X, which effectively crashed the whole token incentive model for engagement farming.
That is a lot to process. So let's take this chronologically. Let's really see how this narrative built up. Let's rewind to Monday, January 12th. The headline in our newsletter was, "The suits are on chain."
Right. And this is arguably the most boring-sounding news that is actually the most revolutionary. We are talking about Bank of New York Mellon.
And just to set the scale here for anyone who doesn't track banking internals, BNY isn't just a regular bank where you have a checking account, right?
No, exactly. They are the bank for other banks. They are the world's largest custodian.
How big are we talking?
They hold nearly $58 trillion in assets. So when they move, the entire floor of the financial system shakes.
Right.
And on Monday, they officially launched a service for institutional clients to transfer funds using blockchain rails.
Okay, let's unpack this immediately because I think this is where people get confused. We already have stablecoins. We have USDC. We have USDT. How is this tokenized deposit different?
That is the multi-trillion-dollar question.
Yeah.
A stable coin like USDC, you should think of it like a digital bearer asset. It's like cash in your wallet.
Okay.
If you have the private key, you own it. You can send it anywhere, anytime. A tokenized deposit is different. It is a digital twin of money that is actually sitting in a vault at the bank. It's a liability of the bank.
So it's a record on the blockchain, but it carries the legal weight of a bank account.
Exactly. It has deposit insurance, legal protections, compliance, all built in. But the real reason this matters, the aha moment, is about time.
Settlement time.
Precisely. In the traditional banking world, in TradFi, moving money on a Saturday night is impossible. The Fed wire is closed.
The banks are closed.
Right. But if you are a massive player like Citadel Securities or Circle or ICE, who are all reportedly involved in this, the markets don't stop. You have margin calls, you have collateral requirements, opportunities 24/7.
So before this, their capital was just dead on the weekend.
He was trapped. BNY's new system lets them settle those transactions instantly on a blockchain without waiting for Monday morning. It unlocks billions of dollars in capital efficiency.
That makes sense. It's not about buying coffee with crypto. It's about the back-end plumbing for the biggest players in the world.
And this didn't happen in a vacuum. This follows the passage of the Genius Act in the U.S. That legislation set the rules of the road, and now we're seeing the heavy machinery start to drive on them.
It's interesting you mentioned heavy machinery because while the banks were getting sophisticated on Monday, the actual usage of public crypto networks was exploding too. I saw a note that usage on the Polygon network hit all-time highs.
It did. The network generated over 13 million POL in fees. And it's important context because it shows that while institutions are building their private permission rails, the public permissionless chains are still seeing massive demand. It's not an either-or situation. Also, NASDAQ and CME Group partnered to launch a crypto index on Monday. So really, Monday was about the adults entering the room and setting up shop.
Well, if Monday was about the adults entering the room, Tuesday. Tuesday was a mix of the visionaries and the, let's call them the opportunists. Let's move to Tuesday, January 13th. The headline was, Strategy Buys Big in the Game, the Eric Adams Scandal.
Talk about a study in contrasts.
Seriously. Let's start with the big money. Strategy, which we all know is Michael Saylor's company, dropped another casual billion.
1.25 billion, to be precise. They acquired another 13,627 Bitcoin.
At an average price over $91,000. That is not cheap. They are not trying to time the bottom here.
No, this is pure conviction. They now hold, get this, 687,410 Bitcoin.
Wow.
That hoard is worth nearly $62.3 billion. They're essentially a Bitcoin treasury company that happens to sell some software on the side.
There was a really interesting, slightly technical detail in Tuesday's update about this. Something about MSCI.
Yes, and this is one of those details that sounds like boring financial jargon, but is actually critical. MSCI provides the global equity indexes that the entire world economy tracks.
Okay.
There was a fear they would exclude digital asset treasury companies like Strategy from their benchmarks because they were too volatile.
And if they get excluded, all the passive index funds, the Vanguards and BlackRocks, they can't buy them.
Exactly. But MSCI decided not to exclude them, and that is a massive win. It means that if you have a generic 401k buying a total stock market index, you are now automatically buying Strategy stock, which means you are effectively buying Bitcoin pressure.
It's a flywheel.
It creates a flywheel of passive capital flowing into the asset class.
That is huge. It's structural. But then we have to talk about the other side of Tuesday. The former mayor of New York City, Eric Adams. I had to read this twice to make sure it wasn't a parody.
It's truly a low point for the industry's image, but a necessary lesson, I think. Eric Adams launched a meme coin called NYC. He promoted it on his personal social media, claimed it was the NYC token. And then 30 minutes later, the liquidity was removed.
He rug pulled it.
Effectively, yes. Investors lost over $2.5 million. It's a classic rug pull, but you usually see this from anonymous developers with cartoon avatars, not a former mayor of one of the largest cities in the world.
It is just baffling. You have Saylor buying billions with a decades-long time horizon and a politician scamming for a couple million in 30 minutes.
It highlights the two speeds of this market. You have institutional accumulation and legitimacy on one side, and you still have these wild, predatory behaviors on the retail side.
Which brings us perfectly to Wednesday, January 14th, because the government is trying to regulate exactly this kind of environment. The newsletter covered the Senate's Clarity Act.
This is where things get a bit technical, but if you hold stablecoins, you really need to listen to this. The Senate Banking Committee released an updated draft of this bill.
And the headline was, Did banks just kill stablecoin yield?
That's the fear. The draft explicitly bans passive yield on payment stablecoins.
Okay, let's define passive yield. So this means if I just hold USDC in a wallet, I can't earn 5% interest on it like a savings account.
Exactly. And if we connect this to the bigger picture, it's obviously a move to protect community banks.
Right.
Think about it. If a crypto platform can offer you a risk-free 5 or even 10% yield on a stablecoin, why would you keep your money in a traditional regional bank earning, what, 0.5%?
You wouldn't. The money would fly out the door.
Deposit flight.
Mm-hmm.
The banks were terrified of it, so they lobbied to make that competition illegal. They're building a regulatory moat.
But the newsletter mentioned a loophole, or at least a different path, activity-based rewards.
Yes, this is the compromise. The bill says you can't get paid just for holding, but you can get rewards for doing. Meaning transaction rewards, loyalty programs, participation. Think of it like credit card points, but for crypto. Or, and this is crucial, yield derived from actually using the money in DeFi protocols. The bill reportedly contains protections for DeFi developers.
So if I put my money into a decentralized protocol, that yield might still be legal.
Ideally, yes, because it's not a centralized issuer promising you interest. It's a market rate.
Yeah.
And interestingly, the newsletter noted that Coinbase reportedly finds this acceptable. On Wednesday, at least, they seem to think they could work with it.
It sounds like the government is saying you can have your crypto, but you have to work for the yield.
Precisely. Also worth noting on Wednesday, Polygon was making moves to become a regulated payment platform in the U.S. by acquiring Coin and Sequence. So again, everyone is rushing to get compliant. They see the writing on the wall.
Right. So we have banks innovating, whales buying, and the government regulating. That pressure cooker exploded on Thursday. Let's look at Thursday, January 15th, the headline. the rocket relaunches.
This was the day the market finally woke up. Bitcoin surged past $97,000.
Hitting an 8-week high. Now, we know Saylor was buying, but was that enough to push it this high?
That provided the floor, but the explosion came from a short squeeze combined with massive ETF inflows.
Walk us through the mechanics of that short squeeze.
So leading up to Thursday, a lot of traders were betting against Bitcoin. They held short positions, expecting the price to drop or reject at 95K. But then, on Thursday alone, the U.S. spot ETFs saw over $750 million in inflows.
That is a huge amount of buying pressure.
It is. And as the price started to tick up from that buying, the people betting against Bitcoin started losing money. To close a short position and stop the bleeding, you have to buy the asset back.
So the skeptics are forced to become buyers.
Exactly. Over $680 million in short positions were liquidated in 24 hours. It's like throwing gasoline on a fire. You have organic demand from ETFs plus forced demand from short sellers.
And the newsletter mentioned that prediction markets were going crazy over this.
Yes, sentiment just shifted to risk on instantly. On Polymarket, bettors began assigning a greater than 60% chance of Bitcoin hitting $100,000 by the end of January. We're in a Goldilocks macro environment right now. Inflation is cooperating, institutions are buying, the supply is thin.
It really feels like we're inching toward that six-figure psychological barrier. But I noticed one detail in the Thursday update that loops back to our regulation talk. Brian Armstrong, the CEO of Coinbase, announced he opposes the Senate bill we just discussed.
That's a fascinating pivot, isn't it? On Wednesday, reports said Coinbase might find the loopholes acceptable. By Thursday, Armstrong is publicly pushing back.
Why the change of heart?
It likely means that as they dug into the specific language of activity-based rewards, they realized it might be too restrictive. They don't want to hand a total victory to the banks. It shows that this legislation is still very fluid. The industry is still fighting.
The fight continues. Now that brings us to Friday, January 16th. And this one hits close to home for anyone who spends time on crypto Twitter, or X, I should say.
The death of InfoFi.
InfoFi information finance. It sounds very sophisticated, but essentially we are talking about getting paid to tweet.
Right. For the last year or so, we've seen apps like Kaido and others that incentivize users to engage. You reply, you quote tweet, you create content, and you earn tokens.
It turned posting into a job.
And it turned the comment sections into a spam wasteland. We call it AI slop. Just bots and people pasting generic great project comments to farm a few pennies.
And Elon pulled the plug.
He did. X revoked API access for these apps. The stated reason was to stop the spam and the degradation of the user experience.
Which, to be fair, was getting out of hand. But the impact on the tokens was brutal.
Immediate brutal. The token for Kaido crashed over 15% instantly. They had to sunset their Yaps program, which was their engagement farming tool, effective immediately.
So the era of reply guy as a career path is over.
On X, yes. Kaido was pivoting to a studio model, essentially becoming a tool for influencer marketing rather than a farming protocol. It's a maturity moment for social interaction. X is saying, you can build here, but you can't pay people to spam our users.
It's a harsh reality check. And just to wrap up the week on a weird note, the newsletter mentioned something about Mr. Beast on Friday.
Yes, just to prove crypto is still weird. Bitmine announced a $200 million investment into Beast Industries, Mr. Beast's company.
Bitcoin miners investing in YouTube stars. We truly live in the strangest timeline.
We do. But there is actually a logic there regarding energy and compute power, though mostly it just highlights that there's a lot of capital looking for homes right now.
So let's zoom out. We started the week with BNY Mellon, the ultimate establishment building permanent rails. We saw Strategy treating Bitcoin as a treasury reserve asset. We saw the Senate trying to carve out a space for banks alongside stablecoins. And then we ended the week by purging spammy behavior on social media. What is the synthesis here?
The word is maturation.
Maturation.
Think about it. We are seeing the Wild West elements, the rug-pulling mayors, the engagement farming bots being purged or regulated out. At the same time, the serious infrastructure, the ETFs, the custodians, the legislation, is getting solidified.
It feels like a cleanup.
It is. The industry is putting on a suit. BNY Mellon bridges the banking gap. The Senate bill bridges the regulatory gap. And even the X ban bridges the gap to better social norms.
And the price reflecting that at $97,000 tells you that the market appreciates this maturity.
Exactly. We aren't just trading magical internet money anymore. We are integrating with the global financial system. And with 100K on the horizon, the next few weeks are going to be critical to see if that integration holds up under pressure.
Well, we will be here to cover it. That's a wrap on this week's deep dive. There is obviously a lot more detail in the full newsletter, including the specific text of that Senate bill and the charts on the BNY flow, so I highly recommend you check the source material.
Absolutely. The details regarding activity-based yield are going to matter for your portfolio, so it's worth a read.
You can find all that at Nifty Noon on Substack. And if you want to stay ahead of these stories as they happen daily, make sure you follow Nifty Noon on X.
Keep your eyes on the charts.
Thanks for listening, everyone. We'll see you on the other side of 100K.
Goodbye.